You are told that diversification means spreading money across different stocks, bonds, and mutual funds to reduce risk. What if I told you that a 3,0-year-old wealth system has produced more billionaires per capita than any investment strategy ever created? This sounds logical because modern portfolio theory teaches us to avoid putting all eggs in one basket. But there's something that doesn't quite add up when Jewish families represent less than 2% of the population, yet appear on Forbes lists at rates 10 to 20 times higher than statistical probability suggests. Most financial advisors recommend holding small percentages of cash while maximizing invested assets for growth. Why do the wealthiest families in history maintain exactly 1/3 of their wealth in liquid form at all times? Conventional wisdom says cash is dead money that loses to inflation over time. But what if this conventional wisdom is designed to keep you perpetually dependent on market performance rather than positioned for market opportunities? Think about the last time a major investment opportunity appeared in your life or during a market crash. Did you have immediate access to substantial capital without selling other investments at a loss? The rule of thirds operates by dividing wealth into 3 equal portions that serve completely different functions while working together to create what ancient texts called compounding velocity. This explains why traditional diversification fails during the moments that matter most for wealth building. If you want to understand why maintaining 1/3 land, 1/3 business, and 1/3 liquid has survived every economic collapse, war, and persecution across 30 centuries, subscribe to Prof. Jong Explained and share this video with someone who keeps all their money invested because cash doesn't grow. They need to see why the smartest money in history never fully deploys and always stays ready. The system recognizes that wealth exists in 3 incompatible states that cannot be combined without destroying their essential properties. When we say wealth allocation, we mean fundamentally different approaches based on whether you understand these 3 states or collapse them into generic investment categories. For families using the rule of thirds, wealth allocation means maintaining perfect balance across land that cannot be stolen easily and appreciates with population growth, business that generates active income and employs skills directly, and liquid capital that protects against disaster while positioning for opportunity. For conventional investors, wealth allocation means spreading money across asset classes that all depend on market performance and can all decline simultaneously during systemic crises when liquidity disappears and opportunities appear. Think about the difference between owning rental property plus business equity plus substantial cash reserves versus owning stocks, bonds, and REITs that all require selling to access capital when you need it most. This explains something remarkable about how generational wealth actually compounds. Wealthy families don't chase the highest returns in each category. They maintain the 3-way balance even when individual components underperform temporarily. The difference isn't just about investment returns. It creates fundamentally different relationships with opportunity and crisis. Rule of thirds families can act immediately when others must sell. Conventional investors can only react after markets have already moved. But here's where it gets interesting. The rule of thirds doesn't just protect wealth during downturns. It actually accelerates wealth building during the opportunities that mass liquidation creates for those with liquid reserves. King Solomon understood what Benjamin Graham would later call margin of safety, except Solomon built the safety into the structure itself, rather than as emergency reserves or analytical techniques for individual investments. This creates what historical records call circulation, rather than accumulation, because wealth must flow between the 3 categories based on economic cycles rather than sitting static in predetermined allocations. When Solomon's trading fleets returned carrying approximately 16 tons of gold in single voyages, he didn't store it all in temple treasuries or deploy it immediately into new expeditions. Consider how this differs from modern investment advice that encourages maximum deployment for maximum growth. Solomon maintained reserves specifically to capitalize on unexpected opportunities while protecting against unforeseen disasters. The rule of thirds becomes even more sophisticated when we examine how it handles what economists call liquidity traps that destroy conventional investment strategies during economic transitions. Most families fall into the trap of seeing cash as sleeping money and real estate as working money. So they push 70 to 90% into property and businesses, believing this maximizes their productivity and returns But then recession arrives or opportunity appears and they discover they own 4 rental properties but cannot cover 6 months of vacancy, or have equity in businesses but cannot expand when competitors fail. The ancient texts warned against this pattern, calling it haste that leads to poverty because it moves faster than liquidity can support, creating vulnerability disguised as aggressive wealth building. Do you find yourself unable to act on opportunities because your money is tied up in investments that will require selling at the wrong time to access capital? The rule of thirds also exploits what behavioral economists call temporal arbitrage in economic cycles. Families maintaining perfect balance can deploy liquid capital when others face forced liquidation during market dislocations. This positioning advantage means they consistently buy assets at depression prices from families who overcommitted and need immediate liquidity regardless of market conditions or asset valuations. The mathematical result compounds over generations because each economic cycle transfers wealth from overcommitted families to balanced families who maintain permanent ammunition for opportunity deployment. Meanwhile, conventional diversification teaches risk reduction through correlation analysis, but never addresses the fundamental problem of synchronized illiquidity, when all asset classes decline simultaneously and cash becomes king. The rule of thirds also creates what historical analysis shows as community amplification effects. When multiple families maintain a balance, they can provide collective liquidity during individual emergencies without breaking their own structural discipline. Jewish communities developed Jumach, or free loan societies where members contribute to collective liquidity pools that provide interest-free capital for business expansion, medical emergencies, or educational investments without forcing individuals to violate their thirds. This community architecture allows individuals to maintain their balance while accessing larger capital amounts than their personal liquid reserves would provide, creating economic networks that survive even when individual families face disasters. But the system also handles what economists call maturity distribution in ways that prevent synchronized capital needs across time horizons, rather than just asset classes or geographic regions. The rule of thirds requires staggered investment maturities, so capital is always returning, while other capital remains deployed, creating continuous circulation rather than locked positions that mature simultaneously during unfavorable conditions. Most investors diversify by asset class, but synchronize by time, owning stocks and retirement accounts they cannot touch for decades, real estate and 30-year mortgages, and bonds that all mature in similar time frames. When crisis arrives in year 7 of a 10-year plan, nothing is available without penalties or forced sales at unfavorable prices, creating diversified paralysis rather than diversified opportunity. Solomon would have judged this allocation as foolishness rather than wisdom, because it ignores circulation requirements that keep wealth flowing rather than accumulating into illiquid positions. The rule of thirds also addresses what psychologists call overconfidence bias, that destroys wealth through excessive commitment based on temporary success in individual categories, rather than systematic balance. The entrepreneur who deploys 100% into business expansion because recent years produced high returns, or the family that pushes all equity into real estate because leverage amplified gains during favorable cycles. These families weren't wrong about asset quality or market timing, but they violated the fundamental principle that no single category should ever exceed 1/3, regardless of recent performance or future confidence. The balance forces humility and prevents the overcommitment that destroys families when economic conditions change or individual investments face unexpected challenges, regardless of previous success patterns. But there's something even more sophisticated happening here. The rule of thirds doesn't just protect against financial loss. It actually programs different thinking patterns about money, opportunity, and risk management across generations. Families maintaining the balance develop what researchers call circulation mentality, where wealth is seen as responsibility requiring active management rather than possession, allowing passive accumulation through market performance. This stewardship mindset creates educational transmission across generations because children learn principles rather than just receiving money, understanding boundaries rather than just inheriting assets. The teaching becomes encoded as covenant obligation rather than investment strategy, making it more likely to survive generational transitions that typically destroy family wealth within 2 or 3 generations. Meanwhile, families focused on maximizing returns within conventional frameworks often fail to transmit underlying principles because they emphasize results rather than process, outcomes rather than discipline. The rule of thirds also handles what economists call opportunity cost analysis in ways that prevent missing generational wealth transfers during market dislocation. when most families lack ammunition. The liquid third isn't emergency money waiting for disasters, but opportunity money positioned for the investment chances that create dynastic wealth during periods when others face forced liquidation. Historical analysis shows that generational fortunes are typically built during economic crises, when assets transfer from overcommitted families to liquid families at massive discounts to intrinsic value. The families positioned to act during these transfers maintain their advantage, not through superior analysis or market timing, but through structural discipline that keeps ammunition loaded regardless of current market conditions. Consider how different wealth building becomes when you maintain permanent capacity to act, rather than permanent commitment to existing positions that prevent new opportunity recognition deployment. The rule of thirds also creates what behavioral economists call reduced decision fatigue around allocation choices, because the framework is predetermined rather than requiring constant and optimization decisions. Instead of analyzing whether to increase real estate exposure or reduce stock positions based on market conditions, families simply maintain the thirds regardless of temporary performance differences between categories. This removes the emotional decision-making that typically leads to buying high after good performance and selling low after poor performance within categories that require active management and market timing. The predetermined structure also prevents the analysis paralysis that keeps families from acting when opportunities appear, because they're constantly second-guessing their allocation decisions rather than executing within established boundaries. But perhaps the most powerful aspect of the rule of thirds is how it handles what psychologists call loss aversion, that typically prevents families from taking the calculated risks necessary for significant wealth building. By limiting each category to 1/3 maximum exposure, families can afford to lose an entire category and still survive on the remaining 2/3 while rebuilding the damaged component. This structural protection reduces the psychological barriers to taking meaningful risks within each category, because total failure in any single area cannot create family catastrophe or generational setback. The protection also allows families to stay committed during temporary downturns in individual categories, because their survival doesn't depend on any single component performing well consistently. The rule of thirds works because it recognizes that wealth building requires balancing 3 incompatible objectives that cannot be optimized simultaneously without structural discipline to prevent overcommitment to any single approach. Maximum growth requires concentrated investment in highest return opportunities. Maximum safety requires minimal risk exposure and guaranteed returns. And maximum flexibility requires substantial liquid reserves for uncertain timing. The system acknowledges these objectives conflict with each other and provides a framework for balancing them, rather than trying to find perfect investments that somehow provide growth, safety, and liquidity simultaneously. Meanwhile, conventional investment advice typically promises solutions that optimize all 3 objectives through sophisticated analysis and diversified portfolios, but fails during the stress tests when these objectives truly conflict. The rule of thirds perpetuates itself across generations because it produces consistent results during both favorable and unfavorable economic conditions, rather than depending on continuous favorable conditions for success. Families maintaining the balance survive market crashes, economic depressions, currency devaluations, and political instability, while accumulating assets from families who overcommitted during favorable periods. And this survival advantage compounds over multiple economic cycles, creating the statistical overrepresentation in wealth rankings that appears remarkable, but results from mathematical inevitability rather than superior intelligence or market timing. And perhaps most importantly, the rule of thirds transforms wealth from a goal requiring perfect market conditions into a discipline that works regardless of external economic circumstances beyond individual control. The system has survived 3,0 years of economic collapse, war, persecution, and exile, because it doesn't depend on any particular economic system or market condition continuing indefinitely. Instead, it creates internal structure that adapts to changing external conditions, while maintaining the balance that provides both protection and opportunity, regardless of what economic environment emerges. The rule of thirds also creates what economists call temporal arbitrage, advantages that allow balanced families to profit from the timing mismatches that destroy conventional investment approaches during economic cycles. When markets crash and most investors face margin calls or forced liquidation to cover expenses, rule of thirds, families can deploy their liquid reserves to acquire quality assets at fire sale prices from distressed sellers. This countercyclical investment capability means they consistently buy low during periods of mass liquidation and hold through recovery cycles while maintaining enough liquidity to repeat the process during subsequent downturns. The mathematical result is that they accumulate increasing percentages of high-quality assets over multiple economic cycles, while less disciplined families transfer their holdings during moments of financial pressure. But the system also handles what behavioral economists call decision-making under uncertainty in ways that prevent the paralysis that typically prevents families from acting during the critical moments when generational wealth transfers occur. The predetermined allocation framework removes the need to analyze whether current market conditions favor real estate, business investment, or cash holdings, because the balance is maintained regardless of temporary performance differences. This structural certainty allows families to act quickly when opportunities appear rather than spending time analyzing whether the timing is optimal or whether they should wait for better conditions. Meanwhile, conventional investors often miss the best opportunities because they're trying to optimize their allocation timing rather than maintaining consistent availability to act when markets dislocate. The rule of thirds also addresses what psychologists call regret minimization in investment decision-making by ensuring that no single allocation mistake can destroy the family's overall financial position. If the business third fails completely, the land and liquid thirds provide survival and rebuilding capital, preventing the total loss scenarios that create generational setbacks for concentrated positions. This protection framework encourages calculated risk-taking within each category, because families know that intelligent failures won't threaten their overall survival or force them to abandon their wealth-building discipline. The psychological safety of the structural boundaries actually increases willingness to take meaningful risks rather than making families more conservative in their individual investment decisions. Consider how different wealth-building decisions become when you know that any single investment can fail without threatening your family's financial survival or forcing you to violate your long-term allocation discipline. The rule of thirds also exploits what economists call information arbitrage, advantages that develop when families maintain direct exposure to three different economic systems simultaneously rather than depending on market analysis. Owning land provides direct information about population growth, zoning changes, infrastructure development, and local economic trends that affect property values before these trends appear in market statistics. Operating businesses provides direct information about consumer demand, regulatory changes, supply chain cost, and competitive dynamics that affect entire industries before these trends appear in public financial reports. Maintaining substantial liquid reserves provides direct information about credit conditions, interest rate changes, currency fluctuations, and banking stability that affect all financial markets before these conditions are widely recognized. This multi-system exposure creates information advantages that improve decision-making across all three categories rather than depending on external analysis or predictions about economic conditions. The rule of thirds also creates what historians call institutional memory across generations that preserves wealth-building knowledge even when individual family members lack business experience or financial education. The structural requirements force each generation to learn about land evaluation, business operations, and liquidity management rather than allowing specialization. That might be lost if key family members die or become incapacitated. This diversified knowledge base ensures that essential wealth management skills remain within the family rather than becoming dependent on external advisors who may not share the family's long-term interests. The educational transmission also prevents the third-generation curse that typically destroys family wealth because children learn principles and boundaries rather than just receiving money without understanding how it was built or should be maintained. But there's something even more sophisticated happening here. The rule of thirds doesn't just preserve wealth across generations. It actually accelerates wealth accumulation by creating what economists call velocity multiplication effects. The liquid third isn't idle money waiting for opportunities. but active capital that continuously circulates between the land and business categories as conditions change and opportunities appear in different sectors. When real estate prices become overvalued, liquid capital flows toward business opportunities until real estate becomes attractive again, then flows back to take advantage of the cycle. This circulation prevents the capital stagnation that occurs when families become overcommitted to single categories and cannot redeploy capital when economic conditions favor different allocation approaches. The rule of thirds also handles what behavioral economists call anchoring bias that typically prevents families from adjusting their strategies when their original assumptions prove incorrect or economic conditions change. Because no category ever exceeds 1/3 of total wealth, families cannot become so committed to any single approach that they ignore contradictory evidence or refuse to adapt when circumstances change. The built-in diversification forces continuous evaluation of all three categories, rather than allowing families to become psychologically anchored to approaches that worked in the past, but may not work in current conditions. This structural flexibility prevents the strategic ossification that typically destroys family wealth when economic conditions change, but families remain committed to outdated approaches that no longer produce results. The rule of thirds also creates what economists call option value in wealth management by maintaining permanent capacity to respond to unexpected opportunities rather than committing all capital to predetermined strategies. The liquid third functions as a perpetual call option on any investment opportunity that appears, providing the ability to act immediately rather than requiring complex repositioning or forced sales to raise capital. This optionality becomes increasingly valuable during periods of economic uncertainty, when opportunities appear suddenly and disappear quickly, favoring families positioned to act over families committed to illiquid positions. The option value compounds over time because families that can act during every economic cycle accumulate increasingly valuable positions, while families lacking optionality miss the critical opportunities that create generational wealth. The rule of thirds works because it transforms wealth building from speculation about future market conditions into discipline about maintaining structural advantages that work regardless of economic environment or individual investment outcomes. The system has produced more billionaires per capita than any other wealth management approach because it provides both protection during unfavorable conditions and positioning during favorable conditions without requiring perfect timing or analysis. Families maintaining the balance survive and thrive during both economic expansion and contraction while accumulating assets from families who overcommit during favorable periods and face liquidation during unfavorable periods. And perhaps most importantly, the rule of thirds creates wealth that serves the family rather than controlling the family, because the structural boundaries prevent the money addiction that typically destroys wealthy families through excessive risk-taking or excessive fear. The balance ensures that no single financial outcome can threaten the family's survival or force them to abandon their wealth-building discipline, creating financial independence rather than financial anxiety, regardless of external economic conditions. If you want to understand how ancient wisdom produces modern billionaires through structural discipline rather than market analysis, subscribe to Prof. John Explained and share this with someone who keeps all their money fully invested because they fear missing returns. They need to see why the smartest money in history values positioning over performance.